Welcome to the Tim Booker book sharing channel. Like, subscribe, and hit the notification bell so you don't miss our updates. Let's explore the world of books together.
Today's book for you is In the Combat Zone of Finance, an insider's account of the financial crisis. This book tells the story of an ordinary corporate worker who becomes the world's first foreign central bank governor and leads a country out of a financial crisis. In 2008, the global financial crisis erupted, and the small country on the edge of the world, Iceland, unexpectedly became the hardest-hit nation. Its banking system collapsed, the currency devalued significantly, leading to severe inflation. Additionally, unemployment rates continued to rise, with jobless individuals from all over the country flocking to the capital, Reykjavik, to participate in protests and demonstrations. Looking around the world, in the midst of the financial crisis, no other country's banking system had suffered such a blow. A set of comparative figures can help you grasp the extent of Iceland's devastation during the financial crisis. After the crisis, a group of bankers were imprisoned, with over half of them in Iceland, totaling 25 people, while in the United States, where the financial crisis initially erupted, only one person was jailed. As for why these individuals were incarcerated, I will elaborate on that later. The author of this book is Svein Harald Øygard, a Norwegian who, in the midst of Iceland's destructive crisis, took on the role of the central bank governor, becoming the first foreign citizen in history to lead an independent central bank. Faced with the wreckage of Iceland's financial industry, Øygard did not panic but immediately assembled a team and implemented a series of measures, ultimately leading to a rapid economic recovery in Iceland. Øygard, who was once an ordinary corporate worker, dramatically transformed into a hero fighting against the tide, tightly intertwining his personal destiny with the global financial crisis. The book I am discussing today is Øygard's comprehensive reflection on the entire incident after the crisis. In order to more vividly reconstruct this crisis, Øygard interviewed nearly 100 relevant individuals, including government officials, bank executives, business leaders, and more. Through these people's observations from different perspectives, you can gain a comprehensive understanding of Iceland's life and death struggle in the financial crisis and, consequently, a deeper insight into the operational principles of the modern financial world. So, how did Øygard, an ordinary person, suddenly transform into a special forces operative, parachuting into Iceland to save a nation? What problems did Iceland face that brought this country, with a per capita GDP ranking among the top 10 globally, to the brink of bankruptcy in the blink of an eye? What measures were taken later that allowed Iceland's economy to revive, experiencing rapid growth once again? What insights do Iceland's experiences offer to other countries? These are the focal points I will discuss in today's interpretation. First, let's talk about how Øygard took office. Everyone has a hero dream in their hearts. If you had the chance right now to become a hero, to rescue a country in ruins and restore its prosperity, would you go for it? Most people would choose to be that hero, but after the initial excitement, you might think that such a thing can only be done by a superhero with steel and iron in science fiction movies. Alternatively, even if there is no superhuman power, you would need at least the financial ability to rival Batman's extravagant wealth, where financial turns into money. However, in reality, scenes from science fiction movies actually unfolded. The author of this book, Norwegian Øygard, is such a heroic figure. He was just an ordinary mortal, not wealthy, but he possessed a mind capable of changing the world. His story of becoming the governor of the Central Bank of Iceland is truly dramatic. One day in February 2009, Øygard was walking at a crossroads in Oslo, the capital of Norway, when his phone suddenly rang. He looked down, and it was a text message asking him to call back the secretary of the Norwegian Ministry of Finance. Øygard made the call, exchanged a few pleasantries, and the secretary of the Norwegian Ministry of Finance directly asked, "Can we appoint you as the new governor of the Central Bank of Iceland?" Øygard was stunned. At that time, he was an executive at McKinsey, holding no official position. For an ordinary corporate worker to suddenly have the opportunity to become a senior official in another country is unimaginable. The temptation of holding great power made Øygard's heart start to race. At the same time, his brain was working rapidly. Iceland had just been deeply mired in a financial crisis the previous year. Sending him was like sending a firefighter. The internal and external conditions in Iceland were complex. Could he handle it? He had been a white-collar worker at McKinsey for over a decade, relinquishing most of the economic knowledge he learned in school to his teachers. The only interaction he had with the central bank was a brief internship at the Central Bank of Norway during a summer break in university. Additionally, going to Iceland as the governor of the central bank as a foreigner was unprecedented, not only in Iceland but also globally. So, the position of the governor of the Central Bank of Iceland was either a golden opportunity if done well or a pitfall if not. Holding the phone, Øygard fell silent, but after a brief moment of contemplation, he agreed. Because he felt that life is short, and such opportunities are rare. Øygard's inherent hero dream was awakened. He could have led a stable and comfortable life at the company, but now, he decided to bid farewell to that life completely and embark on a greater mission. However, how did an ordinary person like Øygard suddenly get chosen by fate to become the governor of a country's central bank? At that time, the Icelandic financial sector was in ruins, corruption was rampant, and the government had just undergone a change. Selecting a new central bank governor through normal procedures would take too long. A substitute player was needed at this time. This substitute player had various conditions. Firstly, they should have no connections with the complex forces in Iceland's financial sector. Secondly, this person should not be entirely unfamiliar with Iceland, preferably coming from a Nordic country. Thirdly, this person should possess practical administrative capabilities and be able to get things done, without any ties to the domestic government to avoid accusations of interference in internal affairs. After filtering through these conditions, Øygard became the best candidate. He was a foreigner, from a Nordic country, with political experience. He had served as the Deputy Minister of Finance in Norway for 4 years in the 1990s. However, by 2009, he had been working in the private sector for over a decade and had no direct ties to the Norwegian government. So when the Icelandic government sought help from the Norwegian government, they found Øygard. Of course, for Øygard, getting this opportunity was also due to his outstanding performance and excellent character many years ago at the Norwegian Ministry of Finance. Many seemingly sudden opportunities are backed by efforts from years ago. Next, the Norwegian side urgently arranged for him a crash course in central bank management, teaching practical details of monetary policy, liquidity management, and various aspects of knowledge. After the course, Øygard returned home and dug out his old textbooks on monetary theory from university. Many memories came flooding back as he read, realizing that this was his favorite course in university 25 years ago, and he even got the best grades. However, at that time, he never thought that many years later, he would have the opportunity to become the governor of a country's central bank. Here, the humorous Øygard specifically gave a wake-up call to his economics classmates: pay attention in class because you might receive a call from a distant country to become a hero saving the world at any time. However, the situation in Iceland was not optimistic. Even Øygard's family did not believe in this mission. His brother directly said, "Why don't you accept a real challenge, like leading the Central Bank of Zimbabwe?" As everyone knows, Zimbabwe is one of the countries with the most serious currency problems today, and his brother's words were a joking warning. Deep down, Øygard was also very worried: would he become a clown on stage? Would he fail to complete this daunting task? Nevertheless, since he had taken on this heavy responsibility, he couldn't show any weakness in front of others. When Øygard was about to leave Norway for Iceland, the first secretary of the Norwegian Ministry of Finance who contacted him asked if he had read Norse mythology, which contains gruesome stories about people having their heads chopped off. Øygard quickly replied that he had won a championship at an athletics competition, running very fast. The other party looked confident in him, feeling somewhat reassured. However, what Øygard didn't say was that the championship he won was in shot put. Shot put involves standing in one place and throwing a ball with a chain attached. So, Øygard's point was that he excelled not in running away but in standing his ground. He was prepared: even if there were mountains of knives and seas of fire ahead, he would wade through them. Next, Øygard took office and parachuted into the center of the Icelandic financial storm. However, you may not expect that he is not only the first foreign governor of the central bank in history but also facing the country most severely affected by the financial crisis. To explain, during the global financial crisis in 2008, with so many countries affected, why did Iceland, a small country on the world's edge, become the most severely affected? Shouldn't the United States be the largest affected country? Indeed, the United States suffered significant losses during the financial crisis, but its economic size was large enough. In contrast, Iceland, with a population of less than 400,000, faced much larger losses in proportion to its economic size. By the end of 2008, Iceland's external debt had reached a staggering $130 billion, while its annual GDP averaged just over $20 billion. The scale of external debt was more than 6 times its GDP. Moreover, the destructive impact of the financial crisis on Iceland's financial sector far exceeded that of other countries. All 3 major banks in Iceland went bankrupt, leaving the financial sector in ruins. Iceland became the first country to declare bankruptcy after the financial crisis. So, why did Iceland experience such a severe disaster? This stems from the blind expansion of Iceland's banking system. Before the financial crisis, Iceland's economy was mainly supported by 3 major industries: fisheries, tourism, and aluminum. While these industries developed well, they lacked substantial growth space. How could Iceland's economy take off? This required finding a new industry. In the early 21st century, Iceland chose the banking sector, representing modernization and internationalization without causing environmental pollution. Iceland's banking industry, after some packaging, met world-class standards in various indicators. Subsequently, they set high interest rates, attracting a large number of investors from other countries, and massive funds poured into Iceland. Then, Icelandic banks lent this money to individuals domestically and abroad with very lax scrutiny of their repayment capabilities. Iceland's banking industry operated like a high-speed machine, with a large amount of capital entering from one side and flowing out from the other side, and banks collected interest rate differentials. With the prosperity of the banking industry, stock prices soared. The issuance of stocks brought significant income to the banks. Additionally, Icelandic banks issued a large number of bonds abroad, attracting substantial funds for further investment. The increasing profits of Iceland's banking industry not only promoted further expansion of the sector but also had a significant impact on industries outside banking. As large amounts of funds flowed into Iceland, fixed assets such as real estate and property appreciated significantly, and the profits from trading these assets increased continuously, attracting a large number of foreign investors. The influx of hot money raised the exchange rate of the Icelandic krona, allowing 1 krona to exchange for more foreign currencies. The strong exchange rate also suppressed the inflation that excessive hot money could cause, making the government support this development pattern with confidence. The banking industry gradually became Iceland's dominant sector. In 2007, among the 7 companies listed on the Reykjavik Stock Exchange, 6 were related to banks, and Iceland's industrial leading enterprises ranked 7th. In the Icelandic Stock Exchange, shares related to banks accounted for 55% of the total market value. However, the crisis began to brew amid this favorable situation. At the time, the top 3 banks in Iceland were Landsbanki, Kaupthing, and Glitnir. All 3 engaged in improper operations in their businesses. To boost their stock prices, these banks directly sought buyers, and surprisingly, many of these buyers were companies to which they had previously provided loans. In other words, some individuals borrowed money from the banks to buy stocks of those banks. In this process, the banks benefited from the increase in stock prices, and the individuals buying stocks also became beneficiaries. Not content with this, many executives in the banks directly acted as these stock buyers. The money they used to buy stocks was, of course, borrowed from the banks where they worked. In the top 10 borrowers among the top 3 banks in Iceland, 8 were related to the bank's management. These individuals were either the chairman's son or spouse, or the parents. The book records a dramatic scene after the banking collapse. Øygard's predecessor as the governor of the Central Bank of Iceland took people to rigorously inspect Glitnir Bank, extracted the list of borrowers, and found that those at the forefront were mostly relatives and friends of major shareholders. A witness later recalled that the governor was shaking with anger at that time. What were Iceland's regulatory authorities doing? Why didn't they conduct a rigorous inspection of the financial system beforehand? The answer is that Iceland had its unique national conditions. Because Iceland's banking industry was the leading force driving economic development, it was already a star industry domestically, and even the Financial Supervisory Authority had to give them some leeway. The Icelandic government even set up a committee specifically to manage the Financial Supervisory Authority, and the members of this committee were representatives of various banks. In other words, players could manage referees while playing. In 2007, when some questioned the safety of Iceland's banks, the Icelandic Minister of Finance was not pleased. He said, "Can't you see this party?" The prosperity of Iceland's banking industry gave him strong confidence. However, the crisis had silently arrived. Between September and October 2008, it was expected that Iceland's banking industry would have an outflow of €28 billion, and there would be €42 billion of liquid funds available for use during the same period. However, on September 15 of that year, Lehman Brothers, a company with a history of over 100 years, collapsed, causing panic worldwide. For Iceland's banks, the money that was supposed to flow out did so, but almost all the liquid funds available for use were cut off. Stock prices fell, fixed assets depreciated, and the Icelandic krona depreciated successively. The risk exposure of the banking industry skyrocketed instantly, almost reaching Iceland's GDP for the year. The government was powerless to rescue. The top 3 banks in Iceland declared bankruptcy at a surprising speed. In October 2008, when Kaupthing Bank declared bankruptcy, an advisor to the Icelandic Prime Minister recalled, he saw the Prime Minister sitting there, tears welling up in his eyes. A month later, the Icelandic Prime Minister announced that the country might face bankruptcy. Although this crisis was caused by external shocks, the root cause was the unhealthy banking industry in Iceland. In fact, there were already signs of the crisis before this. One day in March 2006, Landsbanki had already informed the government that its funding chain was about to break, unable to pay the due amount the next day. On that day, the top 3 banks in Iceland held an emergency meeting at the home of the central bank governor, and they came up with a method. Instead of attempting to reduce the size of the banks, they used short-term financing provided by the central bank to increase the reserve ratio of the banks, making it easier to attract deposits from society. Soon, Landsbanki absorbed £4.5 billion, allowing it to come back to life. Later, an experienced Nordic banker said that this was wild and outrageous. Central bank-type financing is meant to meet short-term emergencies and should not be used to achieve economic growth fundamentally. Former governors of the central banks of Norway and Sweden believe that if a bank asked them to dismantle normal central bank funds to provide financing, they would act together with the financial regulatory authorities and send people to inspect the problematic bank rigorously. However, financial regulation in Iceland was absent. This also explains why, in subsequent judicial investigations, more than 20 Icelandic bankers were imprisoned. Another crucial reason why the Icelandic crisis was so severe is that it did not receive assistance from the big brother of capitalist countries, the United States. During the financial crisis, many Western countries received assistance from the United States. Still, Iceland's request for assistance was rejected because the debts of Icelandic banks had reached $170 billion. Iceland needed too much money, and its previous financial ties with the United States were not close, so the United States did not provide assistance. By now, we know that the cause of Iceland's financial crisis lies overseas, but the roots are domestic. To treat the financial crisis, one must punish financial corruption and restore financial order. And Øygard's task was to restore financial order. Back on February 27, 2009, after Øygard officially took office, he found people everywhere reaching out to him for money. However, with a clear mindset, he didn't provide blind assistance. Instead, he first formed a team and requested a clarification of the debts of the government, central bank, and banks individually to prepare for the next steps. Next, Øygard worked hard to revive banks that were in distress and on the verge of bankruptcy. These banks had a significant amount of bad debt, and no matter how much capital was injected, it seemed like a bottomless pit. They had to wait for new buyers, undergo capital restructuring, clear debts, and then the central bank could provide assistance. The period before the arrival of new buyers was the most difficult. During this time, the financial crisis intensified, and the number of unemployed people continued to rise. Angry individuals pointed fingers at the central bank, accusing it of not intervening, and some even filed lawsuits against Øygard, seeking to send him to prison. Fortunately, the Icelandic government rejected these cases, relieving Øygard of concerns, allowing his rescue plan to continue. During the wait for bank restructuring, Øygard didn't sit idle. He, along with his team, visited current shareholders, potential new shareholders, and major creditors of these banks one by one, asking them to make concessions. The survival of the banks through the financial crisis was crucial to maximizing everyone's interests. This effort greatly assisted some banks. Nevertheless, due to the destructive force of the financial crisis, a batch of banks still went bankrupt. Øygard prepared for this by prioritizing the payment of depositors' money over debts to large enterprises during bank bankruptcies, aiming to maintain social stability. The impact of the financial crisis was multifaceted. After the international community saw Iceland's plight, there was a massive sell-off of the Icelandic krona, leading to a significant depreciation. Internally, the krona's devaluation caused inflation, resulting in severe inflationary pressures. Simultaneously, a large amount of capital fled from Iceland, exacerbating inflation. To prevent capital outflows, the Icelandic government implemented capital controls, revoking the right to exchange Icelandic krona for foreign currencies. However, some large export companies in Iceland did not strictly adhere to these regulations. They converted their earnings into foreign currencies and kept them abroad. During the crisis, these companies were almost the only channel for Iceland to attract funds. In response, Øygard compiled a list of Iceland's 30 largest export companies and invited them to meetings at the Central Bank of Iceland. He first understood their difficulties, offered assistance, and then clearly stated the consequences of not complying with currency controls, emphasizing the potential legal consequences. Through Øygard's efforts, a significant amount of funds remained in Iceland. To overcome the crisis, the Icelandic government also made efforts. After Øygard took office, he led negotiations with trade unions and the government, reaching a 3-year freeze on wages and prices and tightening the national fiscal budget. Meanwhile, the depreciation of the Icelandic krona increased exports in fisheries and aluminum industries, and the tourism industry attracted more visitors, contributing to Iceland's economic improvement. However, the banking sector remained unstable and required government fund injections. At this point, borrowing became an option. During Øygard's tenure, one country and one region provided loans to Iceland. The country refers to China, and the region is the autonomous Faroe Islands of Denmark. The loan from the Faroe Islands went smoothly because Iceland had previously assisted them. This time, they generously lent over $40 million to Iceland. Regarding China's assistance, Øygard played a crucial role. In Basel, Switzerland, where central bank governors from around the world meet at the Bank for International Settlements, Øygard's office was next to the office of the governor of the People's Bank of China. When Øygard heard that China was considering a loan, but the decision was delayed, he directly knocked on the door of the governor of the People's Bank of China and had a lengthy conversation with him. After the governor of the People's Bank of China returned to China, discussions took place, leading to China providing a loan of over $500 million to Iceland. These loans significantly aided the recovery of Iceland's banking system. After stabilizing the financial sector, the focus shifted to revitalizing the economy. Before Øygard took office, his ally, the International Monetary Fund, IMF, was already involved. They represented the United Nations in providing assistance to Iceland, holding significant influence. At the end of 2008, shortly after the collapse of Iceland's 3 major banks, during the darkest moments, the IMF set an interest rate of 22% for the loans provided to Iceland, attempting to stabilize the financial ruins of Iceland. Iceland's situation was complex. Due to inflation, there was an excess of cash circulating in society, prompting the need for a high interest rate to draw money back into the banks. However, the Icelandic economy was on the brink of collapse, requiring funds to be provided to society to increase liquidity and stimulate economic development. In this balancing act, the IMF chose a relatively high interest rate. Less than a month into Øygard's term, on March 19, 2009, he lowered the interest rate to 21%, and by April, it was further reduced to 19.5%. The IMF was not pleased. They believed inflation remained severe, and a high interest rate should be maintained to pull funds back from society. When Øygard attended the IMF spring meeting in Washington, a senior leader of the IMF specifically called him to his office and almost shouted at him. The IMF wanted to maintain a high interest rate, but Øygard sought to increase liquidity. The 22% interest rate was akin to forcefully blocking a bleeding artery and applying a steel plate. While it stopped the hemorrhage, it also affected normal blood flow, stifling economic vitality. Øygard resisted the pressure and did not accept the IMF's recommendations. At the same time, he aimed to prevent an exacerbation of inflation. In his words, it was a dash on the razor's edge, maintaining a delicate balance. History proved Øygard right. In May 2009, Øygard continued to lower the interest rate. By the time he left office in August, Iceland's economy had shown significant improvement. The IMF took notice and recognized Øygard's efforts. Of course, the improvement in economic conditions was not only due to interest rate adjustments but also a combination of measures Øygard had implemented. In October, Øygard refueled his car at an Icelandic gas station and saw 3 cars parked nearby, one of them being a newly imported luxury car. He smiled to himself, knowing he had succeeded. Despite his short half-year term, he had led Iceland's economy out of the winter. At that time, other countries affected by the financial crisis were still struggling with economic downturns. From 2009 to 2012, the Icelandic government injected funds into the banking industry and markets totaling 34% of the GDP. However, in the subsequent years, the total funds recovered by the Icelandic government accounted for 43% of the GDP. Iceland became the country most severely affected by the disaster but recovered the fastest and gained the most post-crisis benefits. After Øygard stepped down, the Prime Minister of Norway invited him to serve as the Minister of Finance, but Øygard politely declined. After the turbulence in the storm center, he preferred to return to the stable times when he worked in a company. As we conclude the interpretation of this book, let's take a look back. The book narrates the story of the world's first foreign central bank governor leading a country out of a financial crisis. The protagonist of the story is an ordinary corporate worker, Øygard. After the outbreak of the 2008 financial crisis, he dramatically received the appointment as the acting governor of the Central Bank of Iceland. Despite knowing that it was a temporary role, he faced an incredibly challenging task and had to summon the courage to give it his all. Next, we traced why the financial crisis in Iceland was so severe. It was a result of the chaotic expansion and prevalent corruption in Iceland's banking sector. The regulatory framework, the final barrier against financial crises, was also lacking. Unlike other countries, Iceland had a committee composed of banking personnel above the Financial Regulatory Authority, rendering the regulation virtually ineffective. After the collapse of the banking system, while many corrupt bankers were imprisoned, guiding Iceland out of the crisis remained a puzzle. Lastly, we see Øygard, as the newly appointed governor of the Central Bank of Iceland, parachuting into the heart of the financial storm. His task was not to punish criminals, that was the duty of Iceland's judicial institutions. His mission was to restore financial order. Within a brief half-year term, he implemented several measures. He first clarified the debts of the government, central bank, and banks, then negotiated with export companies, applying both rewards and penalties to promote capital inflow. He borrowed funds from the Faroe Islands and China. Simultaneously, he resisted pressure from the International Monetary Fund, IMF, and lowered interest rates. In the end, this facilitated the economic recovery of Iceland. Of course, during Øygard's tenure as the governor of the Central Bank of Iceland, there are many interesting stories and initiatives worth learning from. If you wish to gain a more comprehensive understanding of the shadows and aftermath of this financial crisis and reconstruction, you can explore further by reading the physical book or an e-book. Through this story, we can observe that in the 2008 global financial crisis, Iceland, seemingly far from the world's center, suffered the most severe blow. On the other hand, while other countries were still struggling in the crisis, Iceland became the fastest to recover. This is not only an important lesson for Iceland but also a profound revelation for countries worldwide. when the financial system expands too rapidly, nations should strengthen regulations, remaining vigilant against the accumulation of bad assets that could trigger systemic financial risks at any time. After a financial crisis occurs, one should not be frightened by the scenes of devastation but should actively stimulate the market, taking into account the country's specific conditions. This approach, not bound by past dogmas and not reliant on external charity, is the sustainable way to face crises. Additionally, the author's transformation from an ordinary citizen to the central bank governor, experiencing the rescue of the country from a financial crisis, can inspire us to maintain resilience in difficult times, face challenges with greater courage, and explore an extraordinary life. Alright, that concludes the interpretation of this book. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom and practice, achieve our financial goals, and create a better future together. Thank you, everyone, goodbye.